Before we begin, please remember that this presentation is for informational and educational purposes only. I am not a licensed financial advisor or insurance agent. The information provided is not a substitute for professional advice tailored to your specific situation. Always consult with a qualified professional before making any financial decisions, and understand that insurance rates, regulations, and availability vary significantly by state and your individual circumstances. The average American driver overpays for their car insurance by $417 every single year. Let that sink in. That's not a typo. $417. That's a brand new set of premium tires. It's a weekend getaway you're not taking. It's a stack of incredible steak dinners you're not eating. It is money that is leaving your bank account for absolutely no reason, and it's going directly into the pockets of some of the largest corporations in the world. And the most infuriating part? They are counting on you never figuring out how to stop it. They have built a multi-billion-dollar empire on a foundation of confusion, complexity, and one big lie. The idea that loyalty is rewarded. Today we are going to burn that lie to the ground. This isn't going to be another boring video telling you to shop around and bundle your policies. You've heard that a million times. That's surface-level advice. We're going deeper. We are going behind the curtain to uncover the system they use to calculate your rate, the psychological tricks they use to keep you paying more, and the exact step-by-step strategy you can use to turn their own game against them and claim the lowest possible rate you are legally entitled to. By the end of this, you will know more about how auto insurance pricing actually works than 99% of the population, including some of the agents themselves. You will have a repeatable playbook to ensure you never overpay again. For years, I was a sucker. I was with the same big-name company since I got my driver's license. You know, the one they have the funny commercials and the catchy jingle. I was a loyal customer. I paid my bill on time every time for over a decade. I thought that meant something. I thought they had my back. Each year, my premium would creep up a little bit. $5 a month here, $10 a month there. I'd call and they'd give me some excuse about rising costs in my area or new statewide regulations. Sounded plausible, so I just paid it. What choice did I have? The wake-up call came when a new neighbor moved in next door. We were talking and the subject of cars came up. We drove similar vehicles, we were about the same age, both with clean driving records. Out of pure curiosity, I asked him what he was paying for insurance. When he told me the number, my jaw almost hit the pavement. He was paying nearly half of what I was. Half, for the same coverage. With a different company. I felt like a complete idiot. My 10 years of loyalty hadn't earned me a discount. It had earned me a penalty. It was a tax for not paying attention. This is the single biggest secret in the auto insurance industry. It's a concept insiders call price optimization, but a more honest name for it is the loyalty tax. Here's how it works. The insurance company's algorithm, this incredibly complex piece of software, analyzes your behavior. It knows how long you've been a customer. It knows if you complain. Most importantly, it predicts how likely you are to go through the hassle of switching providers. If the algorithm flags you as a sticky customer, someone who is unlikely to leave, it will slowly, almost imperceptibly, raise your rates year after year. Not because you became a riskier driver. Not because your car is more expensive to repair. But simply because it calculates that you will pay it without questioning. It is a direct financial punishment for your loyalty. Think about it from their perspective. It's a brilliant business model. Acquiring a new customer is expensive. They have to spend a fortune on advertising. All those Super Bowl commercials and celebrity endorsements. But keeping an existing customer? That's cheap. Especially if that customer doesn't shop around. So, they give the best, most competitive rock-bottom rates to the new customers, the ones they're trying to steal from their competitors. And who subsidizes those low rates? You do. The loyal customer. You're paying a premium so they can offer a discount to your neighbor. Feels like a betrayal because it is. The first step to breaking this cycle is to completely erase the idea of brand loyalty from your mind when it comes to insurance. Your relationship with your insurance company is not a friendship. It is a business transaction, and you have been on the losing end of it. You owe them nothing. Your only goal is to secure the best possible coverage for the least amount of money. Period. You have to be willing to walk away. The moment you internalize this, you take back all the power. Because their entire model, their entire algorithm, is built on the assumption that you won't. So how do you fight back? It starts with understanding that every single renewal period is a new negotiation. It is a chance to reevaluate the entire market from scratch. The quote you got 6 months or a year ago is now completely irrelevant. The market has changed. Your personal data has changed. New competitors have entered your state. The company that was the cheapest last year is very often not the cheapest this year. They move in cycles, constantly adjusting their pricing to gain market share in specific demographics or regions. Your job is to find who is hungriest for your business right now. Most people don't do this. They get their renewal notice in the mail, they see a 4% increase, they grumble about it, and then they pay it. It's easier than the alternative. The thought of making a dozen phone calls, filling out endless online forms, and comparing confusing quotes with different liability limits is overwhelming. And the insurance companies designed it to be that way. They want it to be a hassle. They want you to say, you know what, it's only an extra $7 a month, I can't be bothered. That $7 a month, multiplied by millions of loyal customers, is how they build skyscrapers. But what if you had a system that cuts through all that noise? A system that forces these companies to compete for your business in a transparent head-to-head battle where you hold all the cards? That's what we're building here. The first pillar of that system is recognizing and rejecting the loyalty tax. It's a mental shift. From now on, you are a free agent. You are a mercenary. Your allegiance is to your wallet and nothing else. Now, simply knowing about the loyalty tax is one thing. Actually defeating it requires a specific strategy. You can't just call your current provider and say, hey, I know you're hitting me with the loyalty tax. They'll just read you a script. You have to prove to them that you're serious. But before you even pick up the phone or click on a single website, there's a crucial piece of information you need to understand. It's a 3-digit number that has a bigger impact on your insurance rate than your driving record, your car, and your zip code combined. And I guarantee most of you have no idea what it is or how these companies are using it against you. Unlocking the secret of this number is the key to going from simply getting a better price to getting the best price. It's the ultimate leverage, and it's exactly where we're going next. This number isn't your FICO score. It's not your Vantage score. It's not the number you see when you log into your credit card app. While it's related to those, this score is something different. Something hidden. It's a ghost in the machine, a number calculated in the shadows by companies like FICO, LexisNexis, and TransUnion specifically for the insurance industry. And in 95% of the United States, it has a bigger impact on what you pay for car insurance than your actual driving record. Think about that for a second. Your history of late payments on a credit card from 5 years ago could be costing you more than if you got a speeding ticket last month. This secret number is called your credit-based insurance score, or CBIS. It's not a measure of your wealth. It's not a measure of your character. According to the insurance industry, it is a statistical prediction of your future, specifically how likely you are to file an insurance claim. For decades, these massive companies have been collecting data, not just on driving but on everything. They've crunched trillions of data points and have come to one single highly profitable conclusion. How you manage your money is an incredibly accurate predictor of how you manage risk in your life, including behind the wheel of a 2-ton metal box. Their logic goes like this. Someone who is meticulous about paying their bills on time, who keeps their debt low, and who doesn't suddenly apply for 5 new credit cards at once is seen as responsible, stable, and forward-thinking. They're playing the long game. The insurance algorithm sees this person and thinks, this individual is probably also the type to get their oil changed on time, check their tire pressure, and not try to beat a yellow light. They are, in the cold, hard language of statistics, a lower risk. On the other hand, someone who has missed payments, maxed out their credit cards, and has a chaotic financial history is flagged by the system. The algorithm doesn't see a person who maybe lost their job, went through a medical emergency, or had a run of bad luck. It sees a pattern of instability. It sees someone who might be more stressed, more distracted, more likely to make impulsive decisions. And an impulsive decision on the highway can be catastrophic. The algorithm flags this person as a higher risk, not because they're a bad driver, but because their financial life suggests a higher probability of filing a claim in the future. Whether you think this is fair or a gross overreach is a question we'll get into. But for right now, understanding the game is the only way to win it. So, how is this secret score even calculated? While the exact formulas are proprietary, locked away in a digital vault, we know the 5 main ingredients that go into the recipe. And the most important ingredient, the one that carries the most weight, is your payment history. This is the king. It accounts for about 40% of your score. Are you paying your bills on time? Every single time? Your mortgage, your car loan, your student loans, your credit cards. A single late payment that gets reported to the credit bureaus can be a wrecking ball to your insurance score, and it can stay on your record for 7 years. The second biggest factor, worth about 30%, is your credit utilization, or how much you owe. This is a huge one that most people misunderstand. Let's say you have a credit card with a $10,000 limit. If you have a $5,000 balance, you are using 50% of your available credit. To the insurance algorithm, that looks risky. It suggests you're stretched thin. But if you have that same $5,000 balance spread across 5 different cards with a combined limit of $50,000, your utilization is only 10%. The algorithm sees that and breathes a sigh of relief. This person has debt, but they have it under control. They have breathing room. Keeping your overall credit utilization below 30% is crucial. Keeping it below 10% is the gold standard. Third on the list is the length of your credit history. This is worth about 15%. The algorithm loves old, established accounts. It shows a long track record of responsible borrowing. That first credit card you got in college and barely use anymore? Don't close it. That account's age is a valuable asset. It acts as an anchor for your entire credit profile, proving you've been in the game for a long time. The longer your credit history, the more data they have on you, and the more predictable you become. And insurance companies love predictability. Fourth, we have new credit, which makes up about 10% of the score. Every time you apply for a new loan or credit card, it generates what's called a hard inquiry on your report. 1 or 2 of these a year is no big deal. But if you suddenly apply for a new store card, a car loan, and 2 new credit cards all in the same month, it sends up a massive red flag. To the algorithm, this looks like desperation. It's a sign of financial distress, which, as we've learned, they equate with higher risk. It's a small piece of the puzzle, but opening too many new accounts too quickly can definitely hurt you. Finally, there's your credit mix, the last 5%. This is about the different types of credit you have. The algorithm likes to see a healthy mix of both revolving credit, like credit cards, and installment loans like a mortgage or an auto loan. It shows that you can responsibly manage different kinds of debt. It's the least important factor, but in a game of inches, every little bit helps. So payment history, amount owed, credit history length, new credit, and credit mix. Those are the 5 pillars that determine your secret insurance score. Now you might be thinking, okay, that's interesting, but how much does it really matter? Let's make this real. Let's take 2 people. We'll call them Sarah and Jessica. Sarah and Jessica are, for all intents and purposes, identical twins to an insurance company. They're both 35 years old. They both live in the same zip code in suburban Texas. They both drive the exact same car, a 2022 Honda CR-V. They both have perfect driving records. Not a single ticket, not a single accident, not a single claim in their entire lives. On paper, their insurance premium should be exactly the same. But it's not. Sarah's premium is $120 a month. Jessica's premium is $250 a month. More than double. Why? Because Sarah has a stellar credit-based insurance score. She's never missed a payment on anything. She keeps her credit card balances low. And her oldest credit card is from 15 years ago. Her score is in the top tier, what insurers call excellent. Jessica, on the other hand, had a tough couple of years. She went through a divorce, had to use credit cards to make ends meet for a while, and was 30 days late on a car payment 2 years ago. She's since gotten back on her feet, but her credit report still tells that story. Her credit utilization is a bit high and that late payment is still there. Her credit-based insurance score is in a lower tier, considered fair or average. So, for the exact same risk on the road, 2 identical drivers with perfect records, one pays over $1,500 more per year for car insurance, simply because of a secret number derived from her financial past. This is happening to millions of people across America right now. They're paying a penalty for financial mistakes, not driving mistakes. They're being judged by an algorithm that doesn't know their story, doesn't care about their circumstances, and has branded them a high risk. This is the system. This is the game you've been playing without knowing the rules. Now you know the most important rule of all. You know what the secret score is, and you know how it's calculated. But knowledge is only half the battle. The real power comes from taking action. So the next logical question is, how do you find out what your score is? And once you know it, what are the exact step-by-step strategies you can use to not just improve it, but to supercharge it, forcing these companies to finally give you the rate you actually deserve? That's where we're going next. So where do you even begin to look for this number? This ghost in the machine that's quietly doubling your car insurance bill without your permission. It's not on your driver's license. It's not on your vehicle registration. Most insurance agents won't even mention it by name. They call it a risk assessment or an underwriting factor. But what it really is a credit-based insurance score. And it is, without a doubt, the single most important and most misunderstood factor in setting your premium. Now, your first thought might be, wait, my credit score? Like my FICO score? And the answer is yes and no. It's not the exact same number a bank uses to decide on a mortgage, but it's built from the exact same raw material, your credit report. Insurance companies have spent billions of dollars developing proprietary algorithms that scrape every last piece of data from your financial history to create a secret, internal score. They've run massive statistical analyses and have come to one overarching conclusion that now governs the entire industry. How you manage your money is the best predictor for how you'll manage your car. It sounds crazy, right? What does a late credit card payment from 2 years ago have to do with you merging onto the freeway tomorrow? To the insurance company, it means everything. In their eyes, a person who pays their bills on time, manages their debt responsibly, and has a long, stable financial history is a person who is predictable. They're responsible. They likely maintain their car, they don't take unnecessary risks, and when they say they'll pay their premium, they pay it. On the flip side, someone with a chaotic credit report, missed payments, high balances, constantly opening new accounts, signals chaos. It signals risk. And risk to an insurer is a 4-letter word that they will charge you a fortune to take on. This is the secret game being played. It's not about your driving record alone anymore. It's about your entire life, as told through the cold, hard data of your credit history. The good news is you can change the story that data is telling. But first, you need to read the current draft. Your mission, should you choose to accept it, is to get your hands on the 3 credit reports that form the foundation of your insurance score. I'm talking about your reports from the big 3 bureaus, Experian, Equifax, and TransUnion. And you do not have to pay a single penny for them. Ignore the commercials for flashy credit monitoring services. The US government has mandated that you have free access to your reports. The only place you need to go is annualcreditreport.com. That's it. It's the official, federally authorized source. When you get there, you'll pull all 3 reports. And I want to be crystal clear about something, because it's a myth that stops so many people. Pulling your own credit report is a soft inquiry. It has absolutely zero negative impact on your score. You can check it every single day if you want. It's only when a lender pulls your report for a new application that it counts as a hard inquiry and can ding your score slightly. So please do not let that fear stop you. Once you have those reports in your hands, you become the detective in your own financial story. You're going to look for inaccuracies, a late payment that wasn't late, an account that isn't yours, and you'll dispute them immediately. But more importantly, you're going to analyze the 5 key factors that make up your score, and we're going to build a step-by-step battle plan to optimize every single one. The first and most heavily weighted factor is your payment history. This accounts for a massive 35 to 40% of your score. It's the simplest and yet the most critical element. Do you pay your bills on time? Every single time? One 30-day late payment can stay on your report for 7 years and can absolutely devastate your insurance score. It's a giant red flag to insurers that screams, unreliable. The fix here is non-negotiable and immediate. You need to automate everything. Your credit cards, your student loan, your cell phone bill, your mortgage, put them all on autopay. Even if it's just for the minimum payment. You can always pay more later, but you can never, ever go back in time and erase a missed payment. This single action is the foundation of a high score. The second factor is the one where we can make the fastest and most dramatic improvements. It's called credit utilization, and it accounts for about 30% of your score. This sounds complicated, but it's actually simple. It's the amount of revolving credit you're using compared to the total amount you have available. Let's say you have one credit card with a $10,000 limit. If you have a $5,000 balance on it, your utilization is 50%. Most financial gurus will tell you to keep your utilization below 30%. That's decent advice for beginners. But we're not here to be decent. We're here to get the absolute lowest rates possible. The people with the highest scores, the 800+ club, operate in a different stratosphere. They keep their utilization below 10%. And the true masters? They keep it below 5%. The insurance company's algorithm sees this and thinks, wow, this person has access to all this credit, but they have the discipline not to use it. They are in complete control. They are a fantastic risk. So how do you do this? First, if you have balances spread across multiple cards, consolidate them onto one or two, and aggressively pay them down. But here's the pro-level hack that can boost your score in as little as 30 days. Most people don't realize that credit card companies typically only report your balance to the credit bureaus once a month, usually on your statement closing date. This means it doesn't matter if you pay your bill in full every month. If you charge $2,000, wait for the bill, and then pay the $2,000 for a brief moment in time, the credit bureaus see a $2,000 balance. The trick is to find out your statement closing date for each card, and then make a payment before that date. Pay the balance down to almost zero a few days before the statement even generates. That way, when the card company reports to the bureaus, it reports a tiny balance, maybe 1 or 2% utilization. You're still using the card, you're still getting the points, but you are strategically controlling the information the outside world gets to see. This is how you game the system. Next up, accounting for about 15% of your score, is the length of your credit history. This is your average age of accounts. The older, the better. It shows stability. The biggest mistake people make here is closing an old credit card they don't use anymore. When you do that, you're not just losing a line of credit, you're erasing a piece of your history. That 10-year-old card you opened in college is an anchor for your score. Closing it can actually cause your score to drop. The strategy here is simple. Never close your oldest accounts. If you're not using one, just put a small recurring charge on it like a Netflix subscription and set it to autopay. This keeps the account active and preserves your precious credit history. The last two pieces are new credit and credit mix, each accounting for about 10%. New credit is about how often you're applying for loans or cards. If you apply for 5 credit cards in a month, you look desperate and high risk. The rule is to only apply for credit when you actually need it. Credit mix is about having a healthy variety of credit types, maybe a mortgage, an auto loan, and a couple of credit cards. It shows you can responsibly manage different kinds of debt. This isn't something to obsess over, but it's good to be aware of. By focusing on these 5 areas, perfecting your payment history, mastering your credit utilization, preserving your credit age, being smart about new credit, and building a healthy mix, you are reverse engineering the insurance company's secret formula. You're no longer a passive victim of their algorithm. You are an active participant, feeding it the exact data it wants to see to classify you as a low-risk, highly desirable customer. You are taking back control. But what if your credit is already perfect? What if you have a pristine 820 score, you've implemented every strategy we just discussed, and your insurance quotes are still coming back shockingly high? It means there's another layer to this. It means there's another secret report they're using against you. This one has nothing to do with your finances. Instead, it's a detailed, permanent record of your entire history with insurance itself. Every claim you've ever filed, every accident you've been in, and even every time you've simply shopped for a quote. It's called a CLUE report, and it follows you for life. And in the next part, we're going to find it, dissect it, and learn how to clean it up. So what exactly is the CLUE report? The acronym stands for Comprehensive Loss Underwriting Exchange. It's a massive database, operated by a data analytics giant called LexisNexis, and it functions as the insurance industry's equivalent of a credit bureau. While Equifax, Experian, and TransUnion track your financial history, LexisNexis tracks your insurance history. For the last 7 years, every interaction you've had with an auto or property insurer is logged, stored, and sold to nearly every insurance company in the country when they're deciding how much to charge you. It's the ghost in the machine, the invisible file that dictates your fate, and 99% of drivers don't even know it exists. Let me tell you about a guy named David. David's a good driver. He commutes 40 minutes to work every day, hasn't had a ticket in a decade, and the last accident he was in was a minor parking lot tap so insignificant he and the other driver just shook hands and drove away. Yet, for the past 3 years, his insurance premium has been climbing like a rocket. First it was an extra $10 a month, then $20. Last year, his renewal jumped by almost $400. Every time he called his insurer, he got a vague, frustrating answer. Rates are just up across the board. It's due to inflation in your area. Repair costs are higher now. He felt powerless, like he was being punished for something he didn't do. He shopped around, but the quotes he got from other companies were just as high, if not higher. It was like every insurer in America had gotten together and decided David was a high-risk driver. Even though his driving record was spotless, David's story isn't unique. It's the story of millions of Americans who are paying too much because of invisible data points in a report they've never seen. But you're not going to be like David, because right now you're going to learn how to pull back the curtain. Under the Fair Credit Reporting Act, the same federal law that gives you access to your credit reports, you are legally entitled to a free copy of your CLUE report once every 12 months. Getting it is surprisingly simple once you know where to look. You won't find it on Google by searching for My Insurance Report. You have to go directly to the source, LexisNexis. You'll need to navigate to their consumer disclosure portal. Once you're there, you can request your report online by phone or through the mail. The online option is the fastest. They will ask for your personal information, name, address, date of birth, and your social security number. Now, I know giving out your social security number online feels sketchy, but in this specific case, it's a secure process mandated by federal law to verify your identity and ensure you, and only you, get access to your private information. Within a few minutes of completing the online form, you'll likely have a digital copy of your report. And when you open it, it might feel like you're reading a foreign language. But let's break it down, because this is where the secrets are buried. You'll see your personal details at the top, followed by a list of insurance policies you've had. But the section you need to focus on, the part that holds all the power, is the claims history. This is David's aha moment. This is where he finally understood why he was being penalized. His report listed 3 incidents over the past 7 years. The first was a legitimate claim from 6 years ago. Someone had backed into his car in a grocery store parking lot. The report showed the date of the incident, the type of claim, a collision claim, and the exact amount his insurance company paid out. $1,450. It was all accurate. No surprises there. But the second entry was a shock. It was a comprehensive claim for vandalism dated 4 years ago. A payout of $0 was listed. David was baffled. He had never been the victim of vandalism. He racked his brain. And then it hit him. 4 years ago, he was leaving a concert and noticed a long, deep scratch along his passenger side door. A key mark. Furious, he called his insurance company's 24-hour hotline from the parking lot, simply to ask what his deductible was for something like that, and if filing a claim would affect his rates. The agent told him his deductible was $1,000 and the repair would likely cost less, so it wasn't worth filing. David agreed, thanked her, hung up, and paid a local body shop $600 out of his own pocket to fix it the following week. He never filed a claim. He never received a dime from the insurance company. And yet, here it was on his permanent record. The simple act of calling to ask a question, an inquiry, had been recorded as a $0 claim. To an underwriter at a competing insurance company, this doesn't look like a question. It looks like a risk. It flags you as someone who has incidents, someone who lives in an area or parks in places where bad things happen to cars. Strike one. The third entry was even worse. It was a liability claim from 2 years ago. It said his policy had paid out over $8,000 for bodily injury. David's heart sank. This was a major, at-fault accident he had absolutely no memory of because it never happened. He was on a family vacation out of the country on the date listed on the report. After a frantic hour of cross-referencing old emails and photos, he realized what must have happened. The vehicle identification number, or VIN, on the report was off by a single digit. A simple typo. A clerical error made by an insurance adjuster 1,000 miles away had attached a catastrophic accident from someone else's life onto his record. This single error was branding him as a high-risk, expensive client. This was the smoking gun. This was why his rates were unbearable. He wasn't being charged for his driving. He was being charged for a ghost. So what do you do when you find these ghosts in your report? You exorcise them. The Fair Credit Reporting Act gives you the absolute right to dispute any information you believe is inaccurate, and the agency, in this case LexisNexis, is legally obligated to investigate. This is the most critical step. You don't call your insurance agent. You don't argue with the company that made the mistake. You file an official dispute directly with LexisNexis through their online portal. You go through your report, line by line, and identify every single inaccuracy. For David, it was the $0 vandalism inquiry and the fraudulent $8,000 liability claim. You then submit a dispute for each item. You'll need to provide a clear, concise explanation of why the information is wrong. For the vandalism inquiry, David wrote, "An inquiry was made on this date regarding my policy coverage, but no claim was ever filed or paid out. This should be listed as an inquiry, not a claim, or removed entirely." For the major accident, he was even more direct. "I was not involved in this accident. My vehicle was not involved. The VIN listed on the claim is incorrect and does not belong to me. I have attached my vehicle registration and proof that I was out of the country on the date of the alleged incident." Once you submit your dispute, the clock starts ticking. LexisNexis has 30 days to investigate. They contact the insurance company that originally supplied the data and ask them to verify its accuracy. If the insurance company can't prove the claim is accurate, or if they simply don't respond, LexisNexis is required by law to remove the item from your report forever. About 3 weeks later, David received an email. The results of his investigation were in. Both the $0 inquiry and the fraudulent liability claim had been deleted. His CLUE report was now clean, showing only the one minor legitimate claim from 6 years ago. The very next day, he started shopping for insurance again. He went to the exact same websites that had quoted him sky-high premiums just a month earlier. The result? His quotes were, on average, 40% lower. He switched to a new provider and saved over $700 for the year. $700. All because he took an hour of his time to look at a secret report, find the errors, and fight back. This power is available to every single person watching this video. Your CLUE report could be costing you thousands of dollars over your lifetime, and you wouldn't even know it. But cleaning up your CLUE report is only half the battle, because there's another, even more secretive report that insurers use to judge you. It has nothing to do with your driving history, and everything to do with your personal life. It's called your insurance score, and it's generated from a completely different set of data that tracks your credit, your payment history, and even public records. And understanding how to find and fix that score is the next key to unlocking the absolute lowest insurance rates possible. This secret number is officially called a credit-based insurance score. And no, it is absolutely not the same FICO or Vantage score you see on Credit Karma or your banking app. Thinking they're the same is one of the most expensive mistakes you can make. While your regular credit score is designed to predict your likelihood of paying back a loan, your insurance score is designed to predict something entirely different, your likelihood of filing a claim. Let that sink in for a second. An algorithm is looking at your financial history, how you manage debt, when you pay your bills, and using it to make a statistical guess about how you'll behave behind the wheel of a car. It sounds crazy, maybe even unfair. And honestly, a lot of people think it is. But for insurers, it's all about one word: correlation. Decades of data and countless studies, many conducted by the Federal Trade Commission and independent universities, have shown a surprisingly strong statistical link between how people manage their financial responsibilities and how much risk they represent as a driver. The logic from the insurer's perspective goes something like this. A person who is meticulous about paying their bills on time, who doesn't max out their credit cards, and who maintains stable finances over the long term is also more likely to be responsible in other areas of their life. They're more likely to perform regular maintenance on their car, like checking their tire pressure and getting oil changes. They're less likely to engage in risky behaviors. The data suggests they are, statistically speaking, a safer bet. Conversely, someone with a history of late payments, accounts in collections, or high credit card balances might be viewed as someone living under more financial stress. And stress, as we all know, can lead to distraction. It can lead to cutting corners, maybe delaying a necessary brake repair. From a cold, actuarial standpoint, this financial instability correlates with a higher probability of filing a claim in the future. It doesn't mean you're a bad person or a bad driver. It's just a game of probabilities, and this score is how they keep track. So, what exactly are they looking at? How is this insurance score actually calculated? It pulls information directly from your credit report, but it weighs the factors differently than a lender would. Let's break down the 5 core components. First and most important is your payment history. This is the king. It accounts for about 40% of your score. We're talking about your track record of paying back debts. Late payments, bankruptcies, and especially accounts that have gone to collections are massive red flags for an insurance score. Even a single 30-day late payment can have a significant negative impact because it signals a break in a pattern of responsible behavior. Second is your outstanding debt, often called credit utilization. This makes up about 30% of the score. This isn't just about how much debt you have, but how much you have compared to your total available credit. If you have 3 credit cards, each with a $10,000 limit, and you've maxed them all out, you're using 100% of your available credit. This is seen as a major risk factor. It suggests you're overextended and under financial pressure. On the other hand, someone with the same amount of debt but with $100,000 in available credit is seen as far more stable. The magic number here is to keep your utilization below 30% and ideally below 10% on each individual card and overall. The third factor is the length of your credit history, which contributes about 15%. A longer history is always better. It gives the insurer a bigger, more reliable data set to judge your long-term habits. Someone who has successfully managed credit accounts for 20 years is a much more predictable, and therefore less risky, client than someone who just got their first credit card 6 months ago. This is why closing your oldest credit card, even if you don't use it, is often a terrible idea. That card is an anchor for your credit history's age. Fourth, we have the pursuit of new credit. This is about 10% of the score. Every time you apply for a new loan or credit card, it generates what's called a hard inquiry on your report. 1 or 2 inquiries a year is no big deal. But if you suddenly apply for 5 new credit cards and 2 personal loans in a single month, it sends up a flare. To an insurer, this behavior signals potential financial distress, a sudden, urgent need for cash flow. It makes you look like a much bigger risk. Finally, the fifth component is your credit mix, also about 10%. Insurers like to see that you can responsibly manage different types of credit. A mix of revolving credit, like credit cards, and installment loans like a mortgage or an auto loan, is viewed more favorably than having only one type of credit. It demonstrates a broader range of financial responsibility. Now here's the critical part. While these 5 pillars are similar to a FICO score, the insurance score algorithm places a much heavier weight on negative events that suggest instability. For example, an account going to collections, especially for a non-credit bill like a utility or medical bill, can be absolutely devastating to your insurance score, potentially more so than your FICO score. Why? Because it implies you're struggling to manage basic living expenses, which in their risk model is a giant red flag. It's also important to know what is not in your insurance score. By law, they cannot use your race, color, religion, national origin, gender, or marital status. Your income, occupation, or employment history are also excluded from the calculation itself. The focus is purely on your past behavior managing financial obligations. This entire practice is, understandably, very controversial. In fact, a few states have taken action. California, Hawaii, and Massachusetts have banned the use of credit information in setting auto insurance rates. In other states like Maryland, Oregon, and Utah, there are significant restrictions on how it can be used. But for the overwhelming majority of Americans living in the other 40-plus states, this score is a powerful, often invisible force dictating how much you pay. You can be the safest driver in the world with a spotless record, but a poor credit-based insurance score can still force you to pay hundreds, or even thousands, of dollars more per year than your neighbor who has the exact same car and driving history. So, like it or not, if you want the cheapest possible insurance, you have to play the game. And the first step in playing the game is to see the playing field. You need to get your hands on the raw data that the insurance companies are using to judge you. You might be thinking, okay, so where do I find my credit-based insurance score? Here's the catch: you can't. Not directly. It's a proprietary score like the secret recipe for Coca-Cola. Each insurance company might even use a slightly different version of the algorithm. But what you can get is something even more powerful: the exact same credit reports that they use to generate that score. You are legally entitled to a free copy of your credit report from each of the 3 major credit bureaus, Equifax, Experian, and TransUnion, every single week. And there is only one official government-mandated website to get them: annualcreditreport.com. Do not go to any other site. Don't fall for the freecreditscore.coms that try to sign you up for a monthly subscription. Go directly to annualcreditreport.com. It is the only truly free, no-strings-attached source. Getting these 3 reports is the most critical first step you can take. It's like getting the blueprints to the system, because these reports are often filled with errors, mistakes that could be unfairly labeling you as a high-risk driver and costing you a fortune. A study by the FDC found that 1 in 5 consumers had a verified error on at least one of their credit reports. Think about that. There's a 20% chance that there is a mistake on your file right now that is artificially inflating your insurance premiums. This is where our mission truly begins. It's not enough to just know the score exists. It's not enough to just download the reports. You have to become a financial detective, combing through these documents line by line, looking for the specific errors and negative items that are poisoning your insurance score. You have to know what to look for, how to spot inaccuracies, and most importantly, how to dispute them and get them removed. You've just requested the secret files on yourself. In the next part, we're going to open them up, page by page, and I'll show you exactly what to look for, the hidden errors, the tiny red flags, and the simple fixes that can slash your insurance bill overnight. Alright, let's crack these open. What you're holding in your hands, or looking at on your screen, isn't just a bunch of paper. This is your financial story told by the insurance industry. And right now, it might be a work of fiction costing you a fortune. We're going to become editors. We're going to find every typo, every exaggeration, every outright lie, and we're going to fix it. There are two main documents we're hunting through. First, your CLUE report from LexisNexis. Think of this as your insurance report card. It's a 7-year history of every auto or property claim tied to your name. Every single one. The second is your MVR, your motor vehicle report. That's your official driving history straight from the DMV. Tickets, points, the works. Insurers scrutinize both of these like ancient texts, and even the smallest error can send your rates into the stratosphere. Let's start with the CLUE report. It stands for Comprehensive Loss Underwriting Exchange. It sounds intimidating, but all it means is that anytime you file a claim, your insurance company reports it to this giant database. Then, when you shop for new insurance, the new company pulls this report to see what kind of risk you are. They're not just taking your word for it that you're a good driver. They're looking at the hard data. So, as you scan this document, the first thing you're looking for is basic accuracy. Look at each claim listed. Is that your car? Is that the correct date of the incident? Most importantly, look at the type of loss and the amount paid. I once helped a woman named Sarah who had a not-at-fault claim on her record. Someone had rear-ended her at a stoplight. It was a slam-dunk, open-and-shut case. The other driver's insurance paid for everything. But on her CLUE report, it was just listed as a collision claim, with no distinction of fault. To a new insurance company's algorithm, a collision is a collision. It looked like she had an at-fault accident, and it was costing her an extra $400 a year. We had to fight to get that single word, "not at fault," added to the file. The moment it was corrected, her quotes dropped. You have to check this. Don't assume they got it right. Next, you're hunting for ghosts. I'm talking about ghost claims. Claims that appear on your record that you never made. It happens more often than you think. A simple clerical error, a typo in a vehicle identification number, or sometimes, something more serious like identity fraud. I worked with a guy named Mark. He couldn't figure out why his rates were sky-high, despite a perfect driving record. We pulled his CLUE report, and there it was, a $20,000 water damage claim on a car he'd sold 2 years prior. The new owner had made the claim, but because of a paperwork screw-up, the VIN was still tied to Mark's old policy in the system. For 2 years, every insurer saw him as a guy with a major, expensive claim. He was being punished for something he had absolutely nothing to do with. A ghost in his machine was draining his bank account. These claims can haunt you for 7 long years unless you exorcise them from your record. Here's a really sneaky one. Look for inquiries. Sometimes just calling your insurance agent and asking a hypothetical question like, "Hey, what if a tree branch fell on my car? Would that be covered?" can trigger an inquiry on your CLUE report. You didn't file a claim. You didn't get any money. You just asked a question. But some companies log that conversation. To the next insurer, that inquiry looks like a potential claim or a near miss. It signals risk. It suggests you live in an area with falling tree branches, or that you're claim conscious. It's insane, but it's real. If you see an inquiry listed that never turned into a claim, you need to dispute it. Should not be there. Now let's switch over to your MVR, your motor vehicle report. This one comes from the state, and it's the official record of your relationship with the road. The first thing you're looking for here are zombies, old violations that should be long gone but are still staggering around on your record. Most states have a look-back period for minor violations. For example, in many places, a simple speeding ticket should only impact your insurance rates for 3 years. But sometimes, due to bureaucratic sludge and outdated systems, that ticket from 4 years ago is still visible to insurers. You served your time, you paid the price, but this zombie ticket is still eating away at your wallet. You need to check the dates on every single violation and compare it to your state's laws. If it's past its expiration date, it needs to be removed. The next thing is even more critical. Incorrect violations. Did you go to court and get a ticket dismissed? Did you take a defensive driving course to have the points removed? That's great. But did the court actually tell the DMV? You would be shocked how often that final crucial step is missed. The court dismisses the case, you walk away relieved, but the charge remains on your MVR like a permanent stain. Insurers pull your record, see the violation, not the dismissal, and jack up your rates. You have to be your own advocate. If you have court paperwork proving a ticket was dismissed or reduced, but it's still showing up on your MVR, you've just found a goldmine of potential savings. And then there's the ultimate nightmare. A case of mistaken identity. It's rare, but it happens. Maybe you have a common name. John Smith in Austin, Texas. There are probably hundreds. If one of them gets a DUI, and a clerk somewhere enters the wrong driver's license number, even one digit off, that DUI could end up on your record. Suddenly, you're being quoted rates as if you're a massive liability, and you have no idea why. This is why you must get your MVR and read every single line item. Don't just assume it's correct. Verify everything. So what do you do when you find an error? You don't just get mad. You get organized. For errors on your CLUE report, you go directly to the source, LexisNexis. They are governed by the Fair Credit Reporting Act, which means you have the right to dispute inaccurate information. Go to their website, find the dispute section, and file a formal request. Be specific. The claim on August 15, 2021 was not an at-fault accident. Please see the attached police report, number 12345. Or, I have never owned the vehicle with VIN number XYZ. This claim does not belong to me. Provide any proof you have. An old bill of sale, a court document, a letter from your previous insurer. You are the CEO of your own data. It's your job to ensure its accuracy. For your MVR, the process is different. You have to go through your state's Department of Motor Vehicles. This can feel like wrestling with a giant octopus, but it's worth it. If a dismissed ticket is still showing up, you'll likely need a certified copy of the court disposition. You take that proof to the DMV and file the required form to have your record corrected. Yes, it might mean a trip to the courthouse or a few frustrating phone calls, but that one-time hassle could save you thousands of dollars over the next few years. Think of it as getting paid $1,000 an hour for your time. Would you do it? Of course you would. Cleaning up these reports is the single most powerful thing you can do to lower your insurance rates before you even start shopping. It's like cleaning your house before you have guests over. You are presenting the best, most accurate version of yourself to the insurance companies. You are taking control of the narrative. Okay, so now your files are clean. Your past is corrected. You might think you're ready to get quotes, but if you do that now, you're still leaving hundreds, maybe thousands of dollars on the table. Because you haven't addressed the single biggest factor that insurers are judging you on right now, in real time. It has nothing to do with your driving record. And everything to do with a secret number you probably don't even know you have. In the next part, we're going to uncover your hidden insurance score. And I'll show you how to boost it in less than 30 days. So what is this secret number? It's called your credit-based insurance score. And right now it's quietly dictating whether you pay a fair price for car insurance, or if you're getting completely fleeced. Now stop. Before you click away thinking, oh, my credit score is great, this doesn't apply to me, you need to understand something critical. Your insurance score is not your FICO score. It's not the number you see on Credit Karma or your banking app. Think of it like a cousin to your credit score. They share the same DNA. They look alike, but they have different personalities and different jobs. Your regular credit score, the one you know, is designed to predict one thing: the likelihood that you'll pay back a loan. That's it. Lenders use it to decide if you're a good risk for a mortgage, a car loan, or a credit card. But your insurance score predicts something entirely different. It predicts the likelihood that you will file a claim. I know what you're thinking. That sounds insane. What does the way I manage my money have to do with how I drive my car? Feels unfair. Feels personal. And you're right. But to the insurance companies, it's not personal. It's just math. Decades of data, collected from hundreds of millions of people, have shown them a powerful, and for them, profitable correlation. A study by the Federal Trade Commission confirmed it. On average, people with lower credit-based insurance scores file more claims, and those claims tend to be more expensive. To an insurer, a person who sometimes pays their credit card bill late isn't just financially disorganized. In their eyes, that person might also be more likely to forget to check their tire pressure, or delay getting their brakes fixed, or maybe just be more stressed and less focused behind the wheel. They see a pattern of risk, and their entire business model is built on pricing risk. So they take the data from your credit report, run it through their own secret proprietary algorithm, and out pops this 3-digit number, your insurance score, that you've never seen. This score is one of the single most powerful factors in setting your premium. In some states, it has a bigger impact than your driving record itself. You can have a perfectly clean record, no accidents, no tickets, but a low insurance score could still label you high risk and double your rates. The good news is you have way more control over this than you think. Because this score is built on your credit report, we can reverse engineer it. We can focus on the exact same 5 factors the insurance companies are looking at, and we can systematically improve each one. The first, and by far the most important, is your payment history. This is the foundation of the entire score. It accounts for about 40% of the calculation. One late payment can be like a wrecking ball to your score. Insurers see a late payment as a sign of chaos, a signal that you might not be managing your life responsibly. And that irresponsibility in their eyes could easily spill over into your driving. A single payment that's more than 30 days late can stay on your report, haunting your insurance rates for 7 long years. So the number 1 rule is non-negotiable. Pay every single bill on time every time. The second pillar is your credit utilization. This sounds complicated, but it's simple. It's just the amount of credit card debt you have compared to your total credit limit. Imagine your total credit limit is a bucket. If you have $10,000 in available credit, that's a $10,000 bucket. If you have a $5,000 balance, your bucket is half full, your utilization is 50%. To insurers, a full bucket is a sign of financial distress. It suggests you're living on the edge, and people on the edge are statistically bigger risks. The magic number here is 30%. You want to keep your total utilization below 30% at all times. But if you want to be in the elite tier, the A+ group that gets the absolute best rates, you get it under 10%. Third is the length of your credit history. Time is your friend here. The longer you've responsibly managed credit, the more predictable and stable you appear. This is why the worst thing you can do is close your oldest credit card account. Even if you don't use it anymore, that card is an anchor for your credit history. It's proof that you've been a reliable borrower for years, maybe even decades. Closing it is like erasing your own good record. Keep it open, use it once every 6 months to buy a coffee to keep it active, and let it age like a fine wine. Fourth is your credit mix. The algorithm likes to see that you can handle different types of debt. A mix of revolving credit, like credit cards, and installment loans like a mortgage or an auto loan, shows financial maturity. It proves you can juggle different payment structures and timelines. You don't need to go out and get a loan just for the sake of it, but if you have a healthy mix, it works in your favor. And the fifth and final pillar is new credit. Every time you apply for a new credit card, a loan, or even a new cell phone plan, it can trigger what's called a hard inquiry on your report. 1 or 2 of these a year is no big deal. But a flurry of them in a short period of time is a massive red flag. It looks like you're desperate for cash, like you're in financial trouble. It screams risk. So be strategic. Only apply for credit when you truly need it. Okay, so those are the 5 pillars. Now for the action plan. How do we boost this score in the next 30 days? Starts with a diagnosis. You need to see exactly what the insurers are seeing. You are legally entitled to a free copy of your credit report from each of the 3 major bureaus, Equifax, Experian, and TransUnion, every single year. The only place you should go to get this is annualcreditreport.com. That is the official government-mandated site. Your 30-day mission begins now. On day 1, you will go to that website and pull all 3 of your reports. Your job is to go through them line by line with a fine-tooth comb. You are looking for errors, a single mistake, a late payment that wasn't late, an account that isn't yours, an incorrect balance, could be costing you hundreds of dollars a year. 1 in 5 people have an error on their credit report. You could be one of them. For the rest of week 1, your mission is to dispute every single error you find. The Fair Credit Reporting Act gives you the right to a fair and accurate report. You can file disputes online directly with each bureau. Be relentless. Provide any proof you have. They are legally required to investigate and respond, usually within 30 days. In week 2, we attack your credit utilization with an advanced technique the pros use. It's called the All Zero Except One method, or AZO. It's simple. Pay down the balances on all of your credit cards to 0, except for one. On one card, you're going to leave a very small balance, like $10. Why? Because if all cards report a 0 balance, the scoring model can sometimes interpret that as you not using credit at all. Leaving one tiny balance shows the accounts are active, but your utilization is practically 0%. It's a powerful trick that can give your score a surprisingly fast boost. In week 3, we use a little-known hack. If you have a parent, a spouse, or a very trusted family member with a long history of perfect credit, ask them to add you as an authorized user on one of their oldest credit cards. You don't even need to have the physical card. The moment you are added, their entire perfect payment history for that account can be grafted onto your credit report. This can instantly add years to your credit age and lower your overall utilization. A word of caution: only do this with someone you trust completely, because if they miss a payment, it will hurt your score too. Finally, in week 4 you coast. You let the changes take effect. You make sure every single bill is paid a few days early. You don't apply for any new credit. You just let your disputes get resolved and your new, lower balances get reported to the bureaus. By the end of these 30 days, you will have fundamentally repaired and optimized the very foundation that your insurance rates are built upon. You've done the hard work. You've boosted your hidden insurance score. You're now in a position to save hundreds, maybe even thousands of dollars. But if you just call your current insurance company and ask for a new lower rate, you're making a monumental mistake. The biggest savings don't come from loyalty. They come from knowing exactly when and how to shop. In the next part, I'm going to reveal the golden window for switching insurance companies. A specific time frame where you have maximum leverage to get the absolute lowest possible price. This window is the period roughly 15 to 45 days before your current policy is set to renew. Not 2 months before. Not 2 days before. There is a strategic sweet spot, and this is it. Let's break down exactly why this period is so powerful. From the insurance company's perspective, drivers fall into 2 main categories: planners and procrastinators. The procrastinators are the ones scrambling for a quote the day before their policy expires. They're often seen as higher risk. Why? Because their last-minute rush might signal financial instability, disorganization, or even that they were just dropped by their previous insurer for non-payment or too many claims. They're in a weak negotiating position. They need insurance and they need it now. The companies know this, and the quotes they offer often reflect that desperation. But the planners, the people who shop for insurance 3, 4, or 5 weeks in advance, they are an entirely different breed in the eyes of an underwriter. These are the people who pay their bills on time. They get the oil changed in their car. They are seen as responsible, stable, and low risk. And what do insurance companies love more than anything in the world? Predictable, low-risk customers. When you shop inside this golden window, you are signaling to every insurance company that you are exactly the type of customer they are fighting to steal from their competitors. You're not desperate. You're a desirable asset. This is a fundamental shift in the power dynamic. You're not just a number asking for a price. You are a prize to be won. And to win you, they are willing to sharpen their pencils and give you their very best rates. In fact, this isn't just some psychological theory. Many of the largest insurance carriers in the country have a specific built-in discount for this. It's often called an advanced quote discount, an early shopper discount, or a plan ahead discount. It can be anywhere from 3% to 10% off your entire premium, just for getting a quote more than a week or 2 before your policy starts. They are literally paying you to be a planner. They are rewarding you for shopping inside the golden window. The vast majority of drivers leave this money on the table. They wait for that renewal notice to show up in the mail, see the price hike, and then maybe if they have time they make a few panic calls a couple of days before the due date. By then the leverage is gone. The advanced quote discount is off the table. You've missed the window. So the first step is to look at your calendar right now. Find the date your auto insurance policy renews. Now count back 45 days. That is the day your golden window opens. Put a reminder in your phone. Block out an hour on your calendar. Treat it like a doctor's appointment. An appointment to save yourself hundreds, maybe even $1,000. Now that we have the when, let's get into the how. Because just shopping at the right time isn't enough. You have to shop the right way. The single biggest mistake people make is believing there is one best or cheapest insurance company for everyone. It simply doesn't exist. The company that's cheapest for your neighbor with his minivan and perfect driving record could be outrageously expensive for you with your sports sedan and a single speeding ticket from 2 years ago. Every company uses a different secret algorithm, weighing hundreds of factors differently. One company might heavily penalize a low credit score, while another cares more about the exact zip code you park in at night. One might love to insure teachers and engineers, while another gives the best rates to union members. You will never know which company's algorithm favors your specific life situation until you check. So, how do you check effectively without spending your entire weekend on the phone? You use what I call the three-pillar approach. You need to get quotes from three distinct types of insurance providers because they all access different markets and offer different pricing. Pillar number 1 is the direct-to-consumer insurers. These are the giants you see on TV all the time. Geico, Progressive, Esurance. You deal with them directly, either online or through a call center. The pros are speed and convenience. You can get a quote in 15 minutes in the middle of the night. The con is that you're doing all the work. You are the agent. If you don't know what coverage you need, or you misunderstand a question, you could end up with a policy that doesn't protect you or costs more than it should. You must get quotes from at least 2 of these big direct writers. Pillar number 2 is the captive agents. These are agents who work for one single company like State Farm, Allstate, or Farmers. Their job is to sell you their company's products. The pro is that you get personalized service and advice from a licensed professional. They can help you understand coverages and make sure you're properly protected. The con, of course, is that they have a massive blind spot. They can only offer you one price from one company. They can't tell you if a competitor down the street could save you 40%. Even if their company isn't a good fit for you, their job is to try and make it work. It's crucial to call at least one captive agent in your area to see what their company's best offer is for someone like you. This brings us to pillar number 3, the secret weapon for a huge number of savvy shoppers, the independent agent. An independent agent or broker doesn't work for an insurance company. They work for you. They represent multiple different insurance companies, sometimes dozens of them, including many excellent regional companies you've probably never even heard of. You give them your information once, and they go out and shop the market for you, bringing back the best options from all the different carriers they work with. This is the ultimate in efficiency. It's like having a professional personal shopper for your insurance. They can find niche companies that might offer incredible rates for your specific profile. The only potential con is that they don't represent every company. For instance, most independent agents can't quote you Geico or State Farm. Do you see why using all 3 pillars is so critical? If you only shop online with the direct writers, you might miss a fantastic rate from a company that only sells through agents. If you only talk to a captive agent, you'll never know if you're overpaying by hundreds of dollars. And if you only use an independent agent, you might miss out on a competitive online-only quote. By taking an hour inside your golden window to get quotes from each of these 3 pillars, you are systematically covering the entire market. You are forcing the companies to compete for your business in a way that 95% of people never do. And here's one more crucial strategy for how to shop. Uncover the truth about bundling. We've all heard it a million times. Bundle your home and auto and save. And it's often true. The discount can be significant. But here is the trap. People assume the bundled price is automatically the cheapest option. It often isn't. The only way to know for sure is to break it apart first. When you're getting quotes, always ask for the price of the auto insurance by itself. Get a standalone auto quote from everyone. Then and only then ask them, what would the price be if I also moved my home or renter's insurance to you? Here's why this is so important. Let's say Company A quotes you $1,500 for auto and $800 for home, with a 20% bundle discount. Your total is $1,840. Sounds pretty good. But what if Company B, a different provider, quotes you a standalone auto policy for just $1,100, and Company C can give you a standalone renter's policy for $200? Your total for the absolute best price on each is only $1,300. The bundle from Company A would have cost you over $500 extra per year. The bundle is only a good deal if the combined, discounted price is lower than the best individual prices you can find on the open market. Don't let the promise of a discount blind you to the bottom line total. Force them to show you the math, both bundled and unbundled. This is what it means to take control. It's not about luck or loyalty. It's about a system. It's about knowing the golden window to maximize your leverage and using the 3-pillar approach to systematically scan the entire market. It's about understanding the bundling trap and making companies prove their value. When you do this, you change the game from being a price taker to a price maker. You now have the timeline and the strategy. You know precisely when to start shopping and the exact method to use to ensure you're seeing the whole picture. But once you're on the phone or filling out that online form, what are the exact things you need to say? What are the specific, often hidden discounts that you have to ask for by name? Because they won't always be offered automatically. There are magic words and key phrases that can unlock savings you never knew existed. And that is exactly what we are going to break down next. The first magic phrase is not some complicated piece of industry jargon. simply asking the right question with the right assumption. When you call your agent or a potential new carrier, you don't ask, "Do you have any discounts?" That's a closed-ended question that allows for a simple yes, followed by them maybe listing one or two common ones. Instead, you are going to take control of the conversation. You are going to say, "I'd like to go through a full discount review to make sure I'm maximizing my savings." See the difference? You've just shifted the entire dynamic. You're no longer a passive customer hoping for a deal. You are an informed client directing an audit of your own account. This phrase signals to the agent that you are serious, you've done your homework, and you expect them to work for you to find every single dollar of savings. It puts the burden of proof on them. Now let's arm you with the specific discounts to call out by name during that review. Think of this as your personal script for that call. First, let's cover the ones you might think are obvious, but are often misapplied or forgotten. The good student discount. Don't just mention your kid has good grades. The magic phrase is, "I need to apply the good student discount for my son, who maintains a 3.1 GPA. What is the best way to submit his transcript for verification?" You state it as a fact to be processed, not a question to be considered. This applies to college students too, even if they're away at school without a car. If they're on your policy, ask about the student away at school discount. The specific wording is key. "My daughter is attending college over 100 miles away without her vehicle. Please apply the distant student discount to my policy." Next up is your profession. You might not think your job matters, but to an insurer it's a data point about risk. Certain professions are statistically safer drivers. So you say, "My occupation is an engineer, or a teacher, or a nurse, or a scientist." Then you ask, "Could you confirm that the preferred occupation discount is reflected in this quote?" Again, you're not asking if it exists, you are asking them to confirm it's been applied. This forces them to look. Many people miss out on this because they assume their job title on a form is enough. It often isn't. You have to ask. Now let's talk about your car itself. Every modern car has a host of safety features, and you're probably paying for them twice, once at the dealership, and again on your insurance if the discounts aren't applied. The VIN number doesn't always tell the whole story. Your script should include this line. "I'd like to verify the discounts for my vehicle's safety features. Can you confirm I am receiving credit for anti-lock brakes, passive restraints like airbags, and the factory-installed anti-theft system?" Many agents will just say, "Yes, it's automatic," but pressing them to confirm each one can sometimes uncover a feature that was missed, unlocking a small but significant percentage off your premium. Bundling is the one discount everyone has heard of. But even here there's a power move. Don't just say, "How much to bundle home and auto?" That's amateur hour. The professional approach sounds like this. "I am looking to consolidate all of my insurance needs with one provider to earn the maximum multi-policy discount. In addition to my 2 vehicles, I have a homeowner's policy and am interested in a quote for a personal umbrella policy. Please provide a quote that reflects the full bundling advantage." This language tells them you are a high-value, long-term customer. You're not just looking for a cheap auto policy. You're a portfolio client, and they will fight harder to win and keep your business, often unlocking deeper, unpublished discount tiers. But here is where we get into the truly hidden discounts, the ones that are almost never offered proactively. These are the affinity and affiliation discounts. Insurance companies make deals with large organizations, alumni associations, professional groups, wholesale clubs, even specific employers, to offer special rates to their members. But it's a labyrinth of partnerships. The agent on the phone doesn't know you graduated from Ohio State, or that you're a member of the American Nurses Association. You have to tell them. The magic phrase is, "Please check for any available affinity group discounts. I am an alumnus of your university, a member of your professional organization, and my employer is," your company name. Be specific. List them all. You might be shocked to find that your college degree is worth a 10% discount you never knew you had. Let's talk about how you drive. Are you a low-mileage driver? With so many people working from home, millions of Americans are. If you drive less than the national average, typically around 12,000 miles a year, you are a lower risk. You deserve a lower rate. But they won't just give it to you. You must declare it. Say this: "My estimated annual mileage is under 8,000 miles. I would like to apply for the low mileage discount." Some companies may require you to use a telematics device that plugs into your car to prove it. But many still offer the discount based on a simple declaration on your policy. You are leaving money on the table if you are driving less but still paying for a standard commuter policy. Here's another one most people forget about: the defensive driving course discount. Taking a state-approved defensive driving course online can take a few hours and cost as little as $25. But it can knock 5 to 10% off your premium for 3 straight years. The return on investment is massive. Once you have that certificate, you call your insurer and say, "I have my completion certificate for a state-approved defensive driving course. Please apply the corresponding discount to my policy, effective immediately." It's that simple. Now for a huge one, your payment method. When they give you the final premium, they'll usually present it as a monthly payment. It seems convenient, but you are paying a premium for that convenience in the form of service fees or installment charges that are baked into the price. The magic question to ask is this: what is the discount for paying the entire 6-month or 1-year premium in full, upfront? Don't ask if there's a discount, ask what it is. This signals you're ready to pay and just want to know the savings. This alone can save you 5 to 15%. While you're at it, ask about the discount for going paperless and setting up automatic payments. Each is another 1 to 3%. They add up. Finally, we come to the most powerful, and perhaps most counterintuitive strategy of all. It involves leveraging the one thing they fear most: losing you as a customer. People believe that loyalty is rewarded. In the insurance world, that is a dangerous and expensive assumption. Often, long-term customers see their rates slowly creep up year after year, in what the industry calls price optimization. They are betting you won't go through the hassle of shopping around. You need to call their bluff. But you can't just call and complain. You need leverage. This means you have to get a competing quote. Once you have a lower quote from a reputable competitor, you make the call. But you don't threaten. You don't get angry. You use a very specific, polite, and powerful script. Goes like this: "Hi, I've been a customer for 8 years and I'd really like to stay with you. I've just been doing my due diligence and have received a quote from another A-rated carrier for the same coverage that is substantially lower. My renewal is coming up, and I was hoping you could review my account for any available retention discounts or other adjustments to help bring my premium closer to the competitive offer I have." This is the nuclear option of savings. You have invoked the magic word: retention. In the call center, this may trigger a transfer to a specialist, the retention department. Their entire job is not to sell new policies, but to save customers who are about to leave. They have access to special, unadvertised discounts that a regular agent does not. You've demonstrated you're a desirable customer, loyal but savvy. You've given them a competitor's target to beat, and you've done it respectfully. This single conversation using this exact script can save people hundreds of dollars in a matter of minutes. It is the ultimate test of your insurer's desire to keep your business. By using these phrases, by shifting from a passive questioner to an active director of your own policy review, you change the game entirely. You are now speaking their language, calling out the specific discounts in their own system, and leveraging the competitive nature of their business against them. But there is one final piece to this puzzle. A strategy that ties all of this together and ensures you get the lowest possible rate not just this year, but every single year. It's a fundamental shift in how you view your relationship with your insurance company. It's the understanding that your insurance company is not your partner. It's not your friend. It's a business. And for decades, the most profitable tool in their arsenal has been our human desire for loyalty. We're taught that loyalty is a virtue. We stick with brands we know, we stay with companies that have been good to us. But in the world of insurance, loyalty is a liability. It's a one-way street where you give your unwavering business, and in return, you're rewarded with slowly, almost imperceptibly, increasing premiums year after year. This is the single biggest misconception we need to shatter. This phenomenon is so well documented in the industry it has a name: the loyalty penalty. Insurers use incredibly sophisticated software, a practice sometimes called price optimization, to analyze your behavior. They know how long you've been a customer. They track if you complain. They analyze how likely you are to shop around. And if their algorithm flags you as a sticky customer, someone who is unlikely to leave, they will systematically raise your rates over time. They know you probably won't notice a 5% increase this year, or a 7% increase next year. But over 5 years, you could be paying hundreds of dollars more than a brand new customer for the exact same coverage. They are banking on your inaction. The secret, then, is to flip the script, to stop being a predictable, loyal customer and become their worst nightmare. An informed, proactive consumer who demands the best price every single time. This isn't about a one-time fix. This is about installing a permanent system into your financial life. I call it the annual insurance audit. It's a non-negotiable yearly event, as important as filing your taxes or getting a physical. Here's how it works. First, the trigger. Right now, I want you to pull out your phone. Open your calendar app. Find the date your current auto insurance policy is set to renew. Now, go back exactly 45 days from that date and create a recurring annual event. Title it, Shop for Car Insurance. This is the most important step. Don't wait for the renewal notice to arrive in your mailbox, already carrying a higher price. By setting this trigger, you are moving from a reactive position to a proactive one. You are now in control of the timeline, not them. Second, the preparation. In that calendar event, make a note to gather your audit packet. This is simple. You need one document, your current policy's declarations page. This is the holy grail. It lists all your coverages, your limits, your deductibles, all your listed drivers, and your vehicle identification numbers or VINs. Scan this document or take a clear picture of it and save it to a folder on your computer or cloud drive. That's it. With this one document, you have everything you need to get perfectly apples-to-apples quotes from any other company in under 10 minutes. The friction of hunting for information is now gone. Third, the execution. When your calendar alert goes off, it's time to execute the 3-quote rule. Your mission is to get a minimum of 3 competing quotes. But not just any 3. You need to be strategic. Quote number 1 should be from a major, direct-to-consumer national carrier. Think of the big names you see on TV every day. They have massive advertising budgets and are constantly fighting for new customers with aggressive introductory rates. Quote number 2 should be from a company that relies more on reputation and customer service, perhaps a mutual company like Amica or a regional player like Erie Insurance. If they operate in your state, their pricing models can be drastically different. And quote number 3 is your secret weapon. You contact an independent insurance agent. These agents don't work for one company. They work for you. They can pull quotes from a dozen or more different carriers, many of which you've never even heard of, all at once. This 3-pronged approach ensures you're covering the entire market, from the giants to the hidden gems. Now let's say you do this. You have your current renewal price of, say, $2,000 for the year, and you get a quote from a competitor for the exact same coverage for $1,600. A $400 savings. The amateur move is to just switch immediately. The pro move, the one that solidifies your power, is to make one final phone call. This is the leverage call. You dial up your current insurance company. You get a representative on the line and you say something very calm and very direct. Hi, I've been a customer for X years and I just received my renewal notice. Frankly, the price is a little higher than I was expecting. I value the service you've provided, so before I make a decision, I did some comparison shopping. I have a quote from another reputable company for the identical coverage I have with you now, and their rate is $1,600. My question is simple. Can you do anything to match that rate or get closer to it to keep my business? And then you do the most powerful thing you can do in any negotiation. You stay silent. Let them respond. One of 3 things will happen. When they say no, they call your bluff or simply don't have the flexibility. Fine. You thank them for their time, hang up, and switch to the new company, completely confident that you are making the right financial decision. 2. They can't match it, but in a scramble to keep you, the agent suddenly discovers a new discount you're eligible for. Maybe a low mileage discount or a new bundle you didn't know about. They might get your rate down to $1,800. That's still a win. It's $200 back in your pocket, and you can still decide to leave for the cheaper offer. Or 3, and this happens more often than you'd think, they match it. They find a way, through a loyalty discount they never offered you before or some other internal adjustment, to bring your premium down to $1,600. You just saved $400 with a single 5-minute phone call, without the hassle of even changing companies. This is the ultimate power move. It forces them to treat you not as a captive asset, but as a valued customer they have to compete for. If you do decide to switch, there is one cardinal rule you must follow. Never, ever cancel your old policy until your new one is officially active. A lapse in coverage, even for a single day, is a massive red flag in the insurance world. It can cause your rates to skyrocket for years. The correct procedure is to purchase the new policy, set its start date, and receive your new insurance cards and confirmation. Only after that new policy has begun do you call your old provider and cancel. Tell them the exact date you want the cancellation to be effective, and request a confirmation email or letter. You'll likely even get a prorated refund for any unused premium you paid. It's a clean, seamless transition that protects you and your wallet. What we've just walked through is the secret. It's not a secret company. It's not a secret discount code. The secret to the most affordable auto insurance in the USA is you. It's a system. It's a mindset. It's the refusal to be a passive participant in a system designed to profit from your inertia. It's the decision to become the active, empowered CEO of your own financial life. You are not just buying a policy, you are managing a recurring expense, and you are holding your vendors accountable for their pricing and service, year in and year out. The hundreds of dollars you save this year will become thousands over the next decade. That's a vacation. That's a significant boost to your retirement account. That's a student loan payment wiped out. All from installing one simple, powerful habit. So before this video ends, before you click to the next thing, do that one thing for your future self. Open your calendar. Set that annual reminder. Because knowledge is only potential power. Action is where the real savings, the real control, and the real secret lies.